Good morning, everybody. Welcome to our seminar this morning, celebrating 100 days, 1 year since the introduction of the VAT here in Oman, and we're going to be focused on the implications for the oil and gas sector this morning. Before we get into the session, just a couple of housekeeping notes. Look, my name is Stuart Triccarelli. I'm Head of Tax for KPMG in the UAE and Oman, and very happy to have you all here this morning. Just on questions, there's going to be time at the end for questions, so please submit your questions in the Q&A tab on the right-hand side. We'll keep a note of those and we'll answer those at the end of the session, as many as we can. Also, there will be a feedback form circulated at the end of the session. Please fill that out. That's good for us to sort of plan future events. Finally, this webinar is being recorded and the recording will be shared with you after the webinar. With that, I'll just turn the next page and display the agenda. I won't go through this in detail due to time, but I'll be pleased to introduce the key speakers today. So first up will be Abba. Abba is a partner based in Muscat and leads our indirect tax practice here in KPMG Oman. She's also co-head of indirect tax in the MESA region. She has more than 15 years of experience in indirect tax advisory and compliance and has advised clients on VAT, GST implementation around Oman, UAE, Bahrain, and India, as well as the excise tax implementation in Oman and the UAE. She's going to be joined by Sumit, who's an indirect tax associate director, also based here in Muscat. He has more than 11 years of experience working across Oman and India, and he has supported clients across sectors, specifically in the oil and gas sector, which is the topic for today. And last but not least, Abdullah, who is an indirect tax analyst based in Muscat. He has been supporting Sumit and Abba on VAT matters and is a key liaison with the Oman tax authorities. So with that, I'll pass over to Abba to start the session and hope you enjoy.
Thanks, Stuart. Hi, everyone. Welcome to the presentation today. Before I kick off the session, I'll need to apologize for my voice. I'm down with an infection. So hopefully you can hear me and make the most out of what we're trying to disseminate on today's webinar. So let's first start with the key developments in VAT. If you look at the next slide, it's been a year since Oman implemented VAT. Teething issues for taxpayers, teething issues for the tax authority, but overall, if you compare it with the general implementations that we've seen across the region as well as the globe, it's been fairly successful. A perfect implementation is only a myth. If you look at it from a revenue collection standpoint, when the tax authority started out, the expectation was they would collect 400 million Omani riyals over a period of 12 months from VAT in Oman. Now, remember that VAT was introduced in Oman only in April, so they had only effectively 8.5 to 9 months for the collections. And for that, Grapevine has it that they've done pretty well. In fact, they've closed the year close to a 12-month target. With that, let's quickly look at what have been the key developments. The tax authority has been invested in ensuring that it communicates on an ongoing basis with taxpayers. And as a part of that, we've seen about 6 to 7 decisions being issued by the tax authority. Now, largely these decisions revolve around registration, where they communicated the threshold for mandatory registration, voluntary registration. Oman, like Bahrain and Saudi, also implemented phased registration. So one of the decisions was related to that. There have been decisions on the zero rating of food items, which food items will be covered, and conscious of the pulse of public. The original list was about 98 products, but over time has been extended to 488 products and eventually close to 500 products. Eventually, there was a decision on zero rating of medicines and medical devices. Apart from decisions, we've also seen the tax authority issue guides, mainly in 2 broad categories. Sector-specific guides, which is what we will also discuss today, in which we've seen oil and gas sector, real estate, transportation, financial services, to name a few. The tax authority continues to roll out more clarifications and guides to enable taxpayers to review their tax positions. In addition to that, they've also been issuing procedural guides for consumer protection, for procedures related to registrations and returns, on reverse charge mechanism, and the most recent ones on profit margin scheme and the capital asset scheme. With that, the tax authority has also issued a couple of notices. One that allows relaxation to taxpayers from taking an approval for issuing simplified tax invoices. Now it's a notification only that taxpayers need to send. And the second, on the treatment of supplies made by taxpayers to government bodies, quasi-government bodies, where the tax authority says that supplies to these bodies has to be at par with supplies made to a private sector. There are no concessions or relaxations given to government body supplies, but we will see a few exceptions being made when we look at the key VAT positions in the oil and gas sector. Apart from that, there has been communication from the Ministry of Energy and Minerals to oil and gas players, which a lot of you may have received initially in the context of what can be accepted in terms of the licensing requirements that are set out in the executive regulations for eligibility for zero rating, and also on the treatment of supplies in the oil and gas sector, and ensuring that contractors and contractors are paid VAT wherever due. So with that, we'll move on to the next section where I'll ask Abdullah to walk us through the key VAT positions before we get into the details at a transactional level. Abdullah, over to you.
Thank you, Abba. As we know, VAT in Oman is applicable on supplies at a standard rate of 5%, unless the supply is specifically exempted, zero rated, suspended, or outside the scope of Oman's VAT. As a quick refresher, in exempt supply, the supplier can neither charge VAT from the customer nor recover any input VAT incurred on purchase used to make such supply. On the other hand, in zero rated supplies, the supplier can charge VAT from the customer at 0% and recover any input VAT incurred on purchase used to make such supply, subject to normal input VAT recovery rules. Also, in output out of scope supply, the supplier cannot charge VAT from the customer, but depending on the nature of the transaction, may be able to recover an input VAT incurred on purchases used to make such supplies. Finally, in standard rated supplies, the supplier can charge VAT from customer at 5% and recover any input VAT incurred on purchase used to make such supplies, subject to normal input VAT recovery rules. So how does one assess whether a supply is standard rated, exempt, zero rated, suspended, or out of the scope for the purposes of Oman's VAT? And that is based on Oman VAT legislation. So the Oman VAT legislation lists supplies that are exempt, zero rated, suspended, outside the scope of Oman's VAT. As you see, the slides capture key supplies exempted, zero rated, outside the scope of Oman's VAT. So, when effected within Oman, the supplies exempt from VAT includes financial services, local passenger transportation, healthcare services, and some supplies that are related to real estate. Also, when effected within Oman, zero-rated supplies include supplies of crude oil derivatives, natural gas, and supplies to customers notified special zones, international transportation, specified food items, and medicine are also rated under 0% VAT. On the other hand, when affected outside of Oman, goods and services exported from Oman qualify for zero rating. Finally, Some supplies that are outside the scope of Oman include supplies between a VAT group and transfer of business on ongoing concerns. Please note, a special treatment usually comes with conditions attached. So the exemption and zero rating are subjected for fulfillment of all conditions prescribed under the Oman VAT legislation. And I think with that, I will hand the presentation to Abha to discuss the key VAT positions in the oil and gas sector.
Thanks, Abdullah. If we move on to the next slide, we now look at the clarifications which have been issued by the tax authority through the sector-specific guide, which was published a couple of months ago. If you look at the oil and gas sector, the supply chain is essentially divided in three categories. Upstream operations, which is also referred to as primary operations, midstream activities, which are also referred to as intermediary activities, and downstream activities. Upstream activities essentially relate to searching for potential hydrocarbons. So these will include geophysical activities such as exploratory drilling as well as testing. It will include processing of hydrocarbons to separate gas, oil, and associated water. It will also include the construction or lease of facilities for lifting, processing, and treatment of hydrocarbons, the plants and facilities required for utilities, storage tanks and facilities in the fields, and last but not the least, abandonment or decommissioning when a particular exploration and production operation is over. If you look at midstream activities, these essentially relate to gathering of unrefined hydrocarbons. So this largely includes transportation of crude oil which has been explored, storage of raw hydrocarbons, as well as liquefaction of natural gas to liquefied natural gas. And if you look at finally the downstream activities, this is the part where the final sale, marketing, or distribution happens. So it includes the conversion of hydrocarbons into the refined petroleum products that retail customers like you and I use. Now, if you look at all these activities, you see that there is an overlap between transportation and storage, because transportation and storage seems to appear in upstream activities, midstream activities, as well as downstream activities. So the guide clarifies that so far as the transportation and storage is related to the field facilities or movement from the field facilities till the production ties into the main oil line, it will qualify as upstream activities. To the extent the transportation or storage is from the field facilities to facilities which have been approved by the government for export, or transportation and storage to refineries, it will qualify as midstream activities. And to the extent the storage is done by marketing companies for subsequent sale, that will fall under downstream activities. Why is this relevant? This is relevant because the zero rating of supplies related to the oil and gas industry in Oman is extended only to upstream and midstream activities. So if we move to the next slide, let's look at the conditions that a taxpayer or a supplier needs to satisfy for zero rating their supplies. These are set out in Article 93 of the VAT Executive Regulations and essentially revolve around 7 conditions. One is that the supply is that of crude oil, oil derivatives, or natural gas, or goods or services in relation to upstream or midstream activities of an operator. Now, we'll see when we go through transaction level details later that the supply has to be for direct and exclusive use in upstream and midstream activities. Any supply which is indirectly or commonly used across business will not be eligible for zero rating. The second condition is that the supplier and the recipient should be taxable persons, which means that they should be registered or required to be registered for VAT in Oman. Then the next requirement is of licensing by the Ministry of Energy and Minerals. And in this regard, The guide now clarifies that so far as suppliers are concerned, it will accept registration with the Joint Supplier Registration System as a proof of licensing by the MEM. So far as the recipient is concerned, there is a list of operators and JV partners that are engaged or authorized to be engaged in upstream and midstream activities that will be compiled by the MEM and then shared with the tax authority. And that will suffice as the proof of licensing by the Ministry of Energy and Minerals. What Article 93 does state is that in some cases, certain supplies will not be eligible for zero rating. These are essentially supplies where input tax credit is blocked, motor vehicles, food and beverages, entertainment. Supplies which are listed under Article 24, Article 5 of the Executive Regulations, recreational, hotel, food and beverages, and supplies that are exempt from VAT. Now, while these are conditions which are laid out in Article 93, there are certain additional requirements that the guide now sets out for supplies to qualify for zero rating. The main one is obtaining a declaration from the operator. So suppliers need to have a declaration. It could be in the form of a purchase order, a contract, or a mere statement where the operator confirms to the supplier that the purchases are for direct and exclusive use in upstream and or midstream activities. In the absence of such a declaration, the tax authority clarifies that the supplier has the right to charge VAT at 5%, and the operator can then assess whether it's eligible for this to claim an input tax credit of the VAT it incurs on these purchases. In addition to that, the tax authority also clarifies that now that the licensing requirements by MEM are established and the supplier needs to have a GSRS certificate, that GSRS certificate should be furnished by the supplier to the tax authority at the time of the VAT registration. And in terms of specific transactions, the tax authority clarifies that the zero rating is only available for contractors who directly supply to operators or operators who supply to other operators. Subcontractors are not eligible for the zero rating because they do not satisfy the conditions of Article 93. And similarly, import of goods or import of services by the operators are also not eligible for zero rating because they do not qualify the conditions under Article 93. With that, let's jump into certain specific transactions. On the next slide, let's look at supplies that are made to government. Now, before I go through the transactions, it's important to remember that there's a distinction that the tax authority is trying to carve out here compared to what's in the VAT legislation. Some countries in the GCC acknowledge that the government and quasi-government bodies are engaged in certain activities in sovereign capacity and therefore make special rules or allow special treatment of supplies made to governments in sovereign capacity. The Oman VAT legislation does not have a provision like that, but the guide does recognize or acknowledge the concept. And therefore, when you look at some of these supplies, which include royalties, signing bonuses, or rent under the EPSA agreement, these are not subject to VAT. If you look at supplies which are or the training levy, which is deducted by operators on behalf of the government, is not considered as VATable. It is outside the scope of VAT because this is not as a part of the operator's economic activity. This is only an activity which the operator undertakes on behalf of the government. There's also certain zero rating which is allowed, which is for supplies to MEM, and this will come up in the issues for consideration. Sale of crude oil to the government or purchase of crude oil by the government from operators. If we move on to the next slide, We also see transactions which are effected between JV partners or operators, where the guide clarifies that cash calls for upstream and midstream activities are not subject to VAT. Treatment of any other cash calls will be subject to clarification from the OTA. They are not necessarily outside the scope of VAT. If you look at recharge of costs, transportation via the main oil line, as well as electricity which is supplied by operators to operators, or connection charges for connecting to the OQGN, which is operated by OQ, they are all zero rate. But when you look at charges such as OBRD, which is essentially compensatory in nature, because they are compensatory in nature, is not subject to VAT. If we move on to the next slide, we then look at a few more transactions when undertaken between third parties and the operators. In this, the tax authority clarifies that when connection charges are charged to the retail gas consumer or an industrial gas consumer, they are standard rated. Electricity and power supplied by utility companies connection charges are standard rate. Electricity and power provided by utility companies is standard rated. Insurance is standard rated. When you look at accommodation expenses, medical insurance, transportation or catering, all of these are subject to a standard rate. The operator would need to assess where they are eligible to recover input VAT credit. In that, the tax authority makes an exception when looking at catering expenses. Technically, food and beverages are restricted for the purpose of availing input VAT credit, but the tax authority allows a relaxation where operations are in a remote place and there is no reasonable alternative for the operator to make these facilities available to the workmen. With that, we'll move to the next section and I'll hand it to Sumit, who can then walk us through some of the procedural reliefs, our experience of VAT compliances, and the issues for consideration for players in the oil and gas sector. Sumit, over to you.
Thank you so much, Abha. Over the last 1 year, the tax authority has extended several procedural reliefs relating to VAT compliances. As per the VAT legislation, we know that the due date of VAT return filing and tax payment is 30th of the month following the end of tax period or the tax quarter. The VAT legislation does not allow an automatic extension in the event the VAT return or payment due date falls on a weekend or a public holiday. But in the Financial Service Sector Guide, which was issued by the Oman Tax Authority, it has been clarified that if the VAT return or the payment due date falls on a weekend or a public holiday, the return can be filed and payment can be made on the next working day. On exchange rate, in case of transactions effected in foreign exchange, the VAT legislation requires the amount or the VAT amount to be converted into Omani riyal using the average buy and sell rate, which is published by the Central Bank of Oman on the date of supply. Now, the CBO rates for each day are generally updated, say around before 2 p.m., but it's not consistent and it's not at the same time. In the financial sector guide, in the financial service guide issued by the tax authority, it was clarified that if the CBO exchange rate is not available on the date of supply, the taxpayer can use rates published on the previous day. So while this relaxation provides some relief to an extent, but the dependency on the timing of CBO publishing the exchange rate remains, which may vary from day to day. Moving on, unlike VAT legislation in other GCC countries that generally require a business to issue an invoice within 15 days from the date of supply, the Oman VAT legislation do not have any specific such provision. So what But in the financial service guide, which was issued, again, the TA or the tax authority has clarified that invoices should be issued within 15 days from the date of supply. The taxpayers also have an option to issue summary tax invoices, which is at the end of month for all supplies made during that month. Technically, a summary tax invoice is also required to contain all the details which are required on a normal tax invoice. But the Financial Service Guide clarifies that if taxpayer challenges incorporating all the particulars as required under the Oman VAT legislation, they can reach out to the tax authority to get a special dispensation or relaxation in this regard. Now, on clarifications, under the VAT legislation in GCC countries, unlike the VAT legislation in other GCC countries, the Oman VAT legislation does not allow or does not have a provision which allow taxpayers a formal mechanism for obtaining advance ruling or clarifications from the tax authority. But in our experience of dealing with the tax authority, we have had a fair share of success in getting the private clarifications on behalf of taxpayer. These clarifications, since private, are binding between the tax authority and the applicant taxpayer. Moving on the input tax apportionment, the VAT legislation requires a taxpayer effecting taxable and exempt supplies to undertake input tax apportionment working at the end of every tax quarter, and then it is followed by an annual true up or true down. Most of the taxpayers would have done this activity in the last return, which we filed in the month of April. But in the financial service sector guide, the tax authority has clarified that subject to satisfaction of certain conditions, a taxpayer may compute input tax apportionment for the first 3 quarters of a tax year based on the previous year's ratio and use the actual figures for the current year only for the last or the 4th quarter. But to avail this relaxation, the tax authority does not require any specific approval to be requested by the taxpayers. Having said that, we know it's always advisable to notify the tax authority to avoid any surprises which may come during any future audits or assessments. On refunds, unlike I would say other GCC countries, which took slightly longer to process initial refund claims submitted after the introduction of VAT, the tax authority in Oman started, I would say, processing and disbursing refund claims relatively early. In our experience, genuine refund claims, which had all the required documents and particulars as per the taxpayer checklist, the tax refund amount were credited to the bank account of taxpayers within a period of 2 to 3 months from the date of filing the refund claim. From a procedural perspective, the taxpayers are now required to file a quarterly refund claim through the taxpayer's checklist separately, and it cannot be filed at the time of filing the VAT return, which was an option in the previous returns. If we look at the financial sector guide, the tax authority has also clarified that the provision of deemed supply may not trigger in certain situations where fees are waived or there is no supply without consideration, or sorry, there is a supply without consideration, provided certain conditions are met. And these conditions essentially require that the fees are waived for genuine commercial reasons. Second, the services relating to the fees waived does not require a purchase of any goods or services directly related to that waiver. And last, the fee are waived for existing customers of the bank who would have either separately paid or in the future will pay consideration for other services. And finally, the tax authority has been allowing deferment of VAT payable at the time of import of goods to the date of filing VAT return instead of paying it upfront in cash. This has helped many taxpayers optimize their working capital requirement. Having said that, it is necessary for taxpayers to monitor the bank guarantee balance they have submitted with the tax authority. Every time a taxpayer import goods under deferment, the VAT due is reduced from the value of bank guarantee. So, in tax periods where a taxpayer has significant imports, the bank guarantee may be depleted fairly quickly. And if the bank guarantee balance with the tax authority is lower than, say, the VAT due on next import, the customs clearance could probably be stalled, and it could lead to demurrage unless the goods are cleared on payment of VAT in cash or by submitting a renewed or an additional bank guarantee with the tax authority. The other practical consideration for taxpayers is whether they can obtain a bank guarantee without locking up funds with their banks to the extent the bank guarantee is to be furnished. If that will be the case, it probably will not make a commercial sense for businesses to opt for deferment. With this, we move on to the next slide on our experience of VAT compliances for the last 1 year. On returns, unlike other GCC countries in Oman, unlike other GCC countries, in Oman, a taxpayer is required to also report details of purchase and sale of capital assets and out of scope purchase, which basically means procurements which are outside the scope of VAT. In our experience, these details are not properly tagged in the IT systems, and as a consequence, not separately or not necessarily captured or correctly reported by the taxpayers. To avoid penalty for incorrect reporting, it is critical that taxpayer find ways of capturing and reporting these details correctly on the VAT returns. In case of import of services, the VAT legislation requires a taxpayer to put a note on the invoices received from the overseas vendor, which should state that VAT liability is due under the reversal mechanism. In our experience during VAT return filing activities, it is not uncommon for taxpayers to miss this requirement, which again, technically, I will say is a non-compliance. In case of import of goods, it is critical to ensure that all imports made, either directly or through agents, where the taxpayer acts as importer on record, those should be captured correctly. It is also important that the buyer document or the customs document are in the name of taxpayer, especially, and it becomes more important when a third party is engaged to help you clear goods from the customs. Unless the taxpayer owns good at the time of their import and they act as the importer on record, the taxpayer may not be eligible to claim credit of VAT they pay on import of goods. To ensure data completeness, taxpayers have the option of requesting all import details made under a taxpayer customs number, because that's the number which you use for importing all the consignments from the customs office on payment of a nominal fee. Next, unlike most of the GCC countries that only allow taxpayers to claim credit of VAT in the tax period in which the right to claim arises, or at the best, the subsequent tax period. The Oman VAT legislation provides a period of 3 years. Therefore, it is advisable to claim input credit only where valid documents supporting the credit eligibility, and if there is no doubt in the credit eligibility of that particular expense, the taxpayer should be claiming input credit. Any excess claim of input credit could lead to penal consequences because of short payment of VAT in the hands of taxpayer. In case of certain nominal value supplies, the VAT legislation allows taxpayer to issue a simplified tax invoice. Now, while the supplier can issue a simplified tax invoice, from an input credit perspective, the VAT legislation does not specifically deny credit or VAT paid to supplier against the simplified tax invoice. This is consistent with the legislation and practice in other GCC countries. But in few history cases, we have seen the tax authority deny input credit or VAT claim on the basis of a simplified tax invoice, saying that this is not a regular tax invoice. On foreign exchange, as we discussed in the previous slide, the exchange rate should be the average of buy and sell rate as published by the Central Bank of Oman. Unlike UAE, Oman specifically does not allow taxpayers to rely on external sources like Thomson Reuters or Bloomberg's of the world, but where taxpayer choose to, or Bloomberg, but in case the taxpayer has to follow different exchange rate, can they reach out to the tax authority to get an approval in this regard or not? Additionally, where taxpayer choose to maintain their books in foreign currency, which means they maintain accounting records in any currency, say US dollar, the VAT legislation requires such taxpayer to obtain a specific approval from the tax authority in this regard. Last, on employer-employee transactions, every taxpayer need to evaluate VAT implications on such transaction, considering employer and employee are related person for VAT purpose. On other VAT compliance aspects, say where a supplier claims zero rating on supplies like supply in the oil and gas sector, because as Ava mentioned that most of the supplies are zero rated when purchased for upstream or midstream activities, or it is supplied to special zone customers, or say it is supply related to international transportation. In all those cases where the supplier claims a 0% VAT, the guides which have been issued by the tax authority requires the supplier to retain confirmation or declaration on the conditions for zero rating. Therefore, it is important that we have the necessary declarations in place. Adding appropriate indemnity in these declarations will only help with recourse in case any future dispute on the tax position arises. On responsible person, as Ava mentioned, the tax authority is now allowing non-resident taxpayers to appoint non-resident as responsible person on furnishing of a bank guarantee. Every taxpayer or responsible person is obliged to notify tax authority and appoint an alternate responsible person if they intend to stay outside of the country for more than 90 days in a tax year. In case of consignment, reserve, or call of stock, because that is peculiar again for this sector, the tax authority in the oil and gas sector guide has clarified that VAT will be due on the day when goods are placed at the disposal of the customer and not the day when the ownership of goods is eventually transferred. So this is all about our compliance experience over last 1 year. Moving on to the next slide on components of compliance. There are several cogs in an effective and efficient compliance process, but most of them generally aim to support 4 pillars of compliance. First, data completeness. Is your data complete? Have you considered transactions effected outside the ERP or outside the system? Have you considered all the relevant tax codes while generating the reports? Whether all the imports, whether made directly or through third-party agents, have been considered? Do we have all the necessary supporting documents to support the reportings. That's all data completeness. Second, data correctness. Is the data which we are reporting correct? Are they mathematically accurate? Is there a reconciliation process for you to cross-verify the correctness of data which we are going to report in the return? Third, tax technical. Do the transactions or data sets which we are using for reporting looks right from a VAT technical perspective? Are they in line with the business? And last but not the least, governance. Do we have sufficient checks and balances? Do you maintain an audit trail on the changes which have been made to the original data set before you put them into the return? Is there a concept of maker checker to avoid such issues? All of these factors are essential in any correct and timely compliance process. And to help our clients achieve these, we at KPMG follow a consistent technology-enabled approach for the VAT compliance process. Moving on to the technology-enabled approach, we have a technology-enabled process depending on whether the data for your VAT reporting is available in a structured form or unstructured. If the data is available in a structured form, like say SAPs and Oracles of the world, the standard tax report available in such ERPs can be used after undertaking a one-time mapping activity. If the data is in an unstructured form and we're not using a standard ERP, in that case, we have prepared a standard template which allows or which basically follows the data sets which are required for VAT return as well as VAT refund applications. We then run the standard tax reports or template through a tool which performs about 80 plus validation checks. So all of this helps to give a dashboard on what's going right and what's going wrong with the VAT compliance process. Moving on to the next slide on issues for consideration. While the guide have provided clarification on various matters, there are still certain issues which require due consideration. First, the Oman VAT legislation currently does not provide any exemption or special treatment for supplies made by government bodies or quasi-government body authorities. In some countries, such as Bahrain, government bodies or public sector entities who are acting in sovereign capacity, they are not considered to be carrying out an economic activity. So while the guide has provided that the sovereign income of government are not subject to VAT, the scope of sovereign function is not very clear. Where a government body or a public sector entity conducts an economic activity in a non-sovereign capacity, for example, where it is in competition with the private sector, it may have VAT obligations. Second, VAT treatment of supplies to or by the MEM. As I mentioned earlier, that in terms of the oil and gas sector guide, supplies by or to MEM are zero rated. However, it is not certain if MEM is engaged in upstream or midstream activities to qualify for zero rating under Article 93. In such an ambiguous situation, it is always advisable to have suitable declaration and indemnity in place, as we spoke in the previous slide. Next, in this sector, we have seen foreign supplier maintaining goods or inventory locally in Oman for supplying to customers on a need or say near to real-time basis. In many cases, such non-resident supplier may not have created or established a branch in Oman or taken a registration as a permanent establishment. In all these situations, it becomes important for the non-resident suppliers to evaluate whether they are creating an obligation for themselves to register for VAT in Oman. And if they do, the local customer who are buying goods or services from such overseas-based supplier need to identify and tag their procurements as local or import, depending on the establishment or the business from which the goods or services are supplied. Next, the draft VAT guide, which was issued for oil and gas sector, clarified that any VAT which you have incurred as an operator during the exploration process can be claimed as input credit, even if the exploration is, say, eventually unsuccessful. This view was on the basis that there is an intention of taxpayer to carry out an economic activity. However, there is no mention of this in the final guide published by the tax authority. Therefore, it is not clear if the intention is to restrict input credit in such situations. Next, on the training levy, as Abha has mentioned, the training levy is not subject to VAT. So any deduction of training levy should not have an impact on the VAT which is to be charged by the supplier. But it is equally important to see how the deduction and remittance of training levy is recorded in the books of account of taxpayer who have retained such training levy. And last, on the licensing requirement of operator, the tax authority in the oil and gas sector guide, as Abha mentioned earlier, has clarified that MEM should be submitting a list of operators with the tax authority. Based on our discussion with the tax authority, they have not received any such list from the MEM. Hence, it is important for operators and partners to check with the MEM if they have submitted a list, and if they are submitting a list, their name should be appearing on that. With this, I will hand over the presentation back to Abha to discuss the key next steps.
So what do businesses need to do? If you're a supplier, you want to examine whether your supplies are eligible for zero rating given the conditions under Article 93. If you're a recipient, you want to check if you are eligible for the zero rating so that you're able to manage your working capital requirements better. Wherever you're issuing or receiving a declaration, ensure that there's some due diligence done to see that the supplies are actually eligible for zero rating, especially for someone who's issuing the declaration, because this is where you're confirming to the supplier that, or affirming to the supplier that the conditions of Article 93 indirectly are satisfied. If you look at the guide, you need to revisit the positions that you've taken to ensure that any rectifications or course corrections that need to be taken are taken in time. If you need to update your contracts, purchase orders, or even put in place a system for getting these declarations and indemnities, you need to put that in place. Update configurations in the ERP, tax codes. If you have vendor management systems that have a concept of matching your purchase orders and your invoicing, and any tax codes that you may have already configured, you'll need to update those. Ensure that you're communicating with internal as well as external stakeholders. And when I say external stakeholders, it is essentially your customers, your suppliers, as well as the tax authority. We've seen from our experience in compliances that the root cause usually is wrong accounting or lack of supporting documents, incorrect tax code. So ensure that you do user training on an ongoing basis. As and when there are updates to the legislation or there's guidance, make sure that the users who use the accounting systems, the ERP or the supply chain is abreast with the changes. And at the end, once you've reviewed your position, and if you find that there are any changes that need to be made to the VAT returns or compliances which have already been filed, please do that before the tax authority initiates for an audit or an assessment. For those of you who've looked at the Oman VAT legislation, the penalties can be eye-watering. And given that we are already over 1 year since implementation, the tax audits are just around the corner. So with that, we'll wrap up the session for today. We'll move to the Q&A section where we'll ask Stuart to come back on and moderate the Q&A section. Stuart.
Thanks, Abha. And let me just open up the questions I've got here. So, so I think the first one, Abba, is for yourself. It's about the recent update from the OTA regarding the checklist while filing VA returns, and whether it's compulsory or whether there's any further update from the Oman Tax Authority.
So just to make sure that everyone's on the same page, let me give some background. When we started the filings for the previous tax quarter, the tax authority issued a notification which said that all taxpayers will be required to submit a taxpayer checklist along with their VAT returns. Now, until then, only taxpayers who were in a refund position were required to submit this checklist. But the notification issued in the last quarter suggested that everyone, not just people in refund positions, would have to submit it. Subsequently, the tax authority has taken that notification off. The submissions of returns for the last quarter happened without taxpayer checklists for businesses that are not in a refund position. Having said that, the tax authority is considering some sort of digital reporting requirements to be introduced. And this is where taxpayers need to ensure that their systems are configured in a way that any data that is called upon, whether it is as a part of the returns, as an annexure to the returns, or for the purpose of audits or assessments, is readily available. Because in the short term, you will see announcements coming from the tax authority for increased reporting. And the taxpayer checklist is a set of 70 questions with about 7 to 8 annexures that require a great deal of or great detail in terms of the transactions. So the short answer to your question, Stuart, is that it's not happening it hasn't happened in the last quarter, but taxpayers should keep an eye out because it may be reintroduced soon.
Okay, but just a follow-up compliance question then that's come through as well. So someone's saying due to PO issues, they haven't issued the tax invoice, but they're still paying the tax on time. Will it create any concern from the OTA?
So the tax authority requires every supply to be supported with a tax invoice. And when I say every supply, it's not just standard rated, but also zero rated and exempt supplies. They haven't made concessions. So if you're not issuing tax invoices, what is the timeline that you need to be looking at? Most other legislations in the GCC require a taxpayer to issue the tax invoice within 15 days. The Oman VAT legislation doesn't have that requirement, but if you look at the financial services sector guide, as Sumit pointed out earlier, businesses now have 15 days from the date of the supply to issue the tax invoices. So yes, you're paying the tax due in time, so you are in a tax neutral position. But if you don't issue the invoices within 15 days from the date of supply, given the recent clarification in the financial services sector guide, the tax authority could say you're in non-compliance and could impose administrative penalties for non-compliance or non-issuance of tax invoices.
Thanks, Abba. There's a question here, Sumit, for you. I'll read it in detail. It's got a detailed question, so let me just read this out word for word. So please note that we are supplying fuel to many companies in the upstream activity with a VAT rate of 5% based on the MEM letter dated 13th of July 2021, which stated that the operator shall bear the VAT on taxable supply they received from the taxable person, and the operators have the right to claim a refund for input VAT paid. So are we now required to issue zero rate invoices after the oil and gas guide for our customers and upstream midstream activity?
Yeah, thanks, Stuart. So yes, so the MEM clarification which came in July 2021 said so that we can charge VAT of 5% to the operators, and they will be in a position to claim input credit of VAT which we charge. But now, based on the oil and gas sector guide, which has been issued in the month of January earlier this year, if the supplies are in relation to upstream or midstream activities, and it satisfies all the conditions which are required as per Article 93 of the Executive Regulations, which Abba spoke in detail, in that case, the supplier can charge VAT at 0% to the supplier. But it would be important for the supplier to take a declaration or indemnity from the customer so that in case the VAT eventually becomes payable on the supply due to non-fulfillment of any of the conditions, the supplier will have a recourse to go back to the customer and recover the VAT which they did not charge originally.
Thanks, Sumit. Okay, there's another question here, and Sumit or Abdul, I'm not sure who's the best person to pick this one up, but basically it's around the claim of VAT, and does legislation require to claim input VAT in a specific return or a certain period for recovery?
And I'll take that up, Stuart. So the Oman VAT legislation provides that the credit can be claimed within 3 years from the date of invoice, in which the right to claim or the period in which we received the invoice, which created a right to claim the input tax credit. So yes, there is a provision in the legislation, and you can claim credit up till a period of 3 years.
Okay. Just one clarification question that just came in. Talking about the last quarter submission, someone was in a receivable position, and they were advised that a checklist is not required. Can you confirm if we are still required to fill a checklist now, even if we are not seeking a refund? And how do we confirm that we have a refundable balance with the tax authorities?
I can take that maybe. So what we understand is that the business in the last quarter was not in a refundable position. And the question is whether they still need to submit a taxpayer's checklist. The answer is, as of now, no. As of now, only businesses that are in a refundable position need to submit a taxpayer's checklist in the quarter in which they are in a refund position.
Okay, thanks for that. There's a couple more coming through as well. This was another, you might be able to answer this quite quickly. This is with summary tax invoices. Will there be any serial number controlling for summary invoices?
I can take that up, Stuart. So as per the VAT legislation, if you issue a summary tax invoice, the legislation does not require those summary invoices to be sequentially numbered as compared to a normal tax invoice. So even if the taxpayer don't mention the serial number on the invoice, that will be a valid simplified simplified tax invoice.
Okay. There's a few more questions. Can a customer refuse to pay VAT charged by us as supplier if the conditions of Article 93 are not satisfied?
I can probably take that. Obviously, you'll need to have a commercial discussion with your customer on why the customer is refusing to pay you VAT when you believe it's due. If you look at the guide clearly says that if the conditions of Article 93 are not satisfied, or the conditions of Article 93 are satisfied, but the customer does not give you a declaration, also in line with one of the clarifications or guidance notes which was issued by the MEM last year. Having said that, these are just guides which are issued by the tax authority to give you clarity on transaction treatment. These are not binding either on the tax authority or the customer or you. The interpretations can change. So from a practical point of view, you obviously need to sit down and have a commercial discussion with the customer as to why they're not paying the 5%. And if you are forced into charging a 0%, you then want to negotiate appropriate indemnities, where in the future, if the tax authority questions the tax position adopted by you and says, no, the supply should have been 5%, not 0%, then you're able to recover that tax from your customer along with any additional tax or penalties that the tax authority may want to impose on you.
Okay, look, I know we're over time, but I've just got a couple more questions that have come in. So what I might ask the panelists just to stay on while I'll ask these, and then we should be able to wrap this up in a couple of minutes. But Thomas Cummins' question, is there any formative declaration issued by the tax authority for signing with customers or suppliers?
I can take that up. So as Ava mentioned, it is important that we take the declaration from the customer, but the tax authority does not prescribe any specific format which should be used by the suppliers to take the declaration. The declaration should effectively provide that the customer is certifying the purpose of purchase of the goods or services, that which will mean that the goods or service are for use in upstream or midstream activities. So depending on your commercial arrangement and your legal team inputs, the taxpayers can have their own declaration to the extent it provides them suitable indemnity and declaration for a recourse in future.
And just to add, just to add to what Sumit said, if you're looking for guidance on wordings that would be acceptable by the tax authority, the guide categorically sets out what the tax authority would look for in terms of the language of the confirmation. So when you're putting the declaration together or seeking it from the customer, you probably want to stay as close to those wordings as are acceptable by the tax authority as you possibly can.
Yeah, just to follow up on that, also they're asking, someone's asking, is the declaration by operator required to be stamped or rectified by MEM? I think we touched on that before, but just looking for clarification on that.
There's no requirement really to get it stamped or ratified by the Ministry of Energy and Minerals. But you obviously want to ensure that the person who's issuing this to you is an operator who's authorized to undertake upstream or midstream activities according to the MEM. But stamping it or getting it ratified by the MEM is not a part of the requirements either in the legislation or in the guide.
Okay, just a couple more have just come through now, team. This one's around imported services, and when are services considered as an imported services?
So sure. So for import of service, generally, if we are paying for any service to an overseas vendor, that will qualify as import of service. The VAT legislation has provisions around place of supply, which helps to determine whether the service is considered as imported in Oman or not. Generally, if you receive any services such as consultancy services, legal services, and IT support, backup or say management consultancy from group company overseas, those will qualify as import of service. But if these are in relation to real estate services and the real estate is located outside of Oman, they probably may not qualify as import of service. So in most of the cases, any service import will qualify as import liable to VAT under reversal mechanism, unless they have been specifically carved out under different place of supply provisions in the VAT legislation.
Okay, just look, 3 more questions and then we'll close it. So if the customer is given a declaration and using it for a different purpose other than the upstream or midstream activity, will the non-compliance fall on the supplier or the customer?
The supplier. The obligation under the VAT legislation is usually that of the supplier. And it is at the end of the day, the supplier's responsibility to ensure that the tax positions they've taken are correct and in line with law. So if there is an audit or an assessment and the tax authority looks at these declarations, they have no reason to not say, or they have every reason to say that the declaration says that they are using these purchases, the customer is using these purchases for other than upstream and midstream activities. So it is the responsibility of the supplier to have done its due diligence and charge a 5% if applicable.
Okay. Just 2 more come through. Let me just, sorry. This might be a simple one. Food and accommodation expenses, can they be claimed as an input tax credit?
Sorry, Stuart, which expense you said?
Food and accommodation expenses, can they be claimed as an input tax credit? Yeah.
Okay. So generally, the VAT legislation provides a restriction on input credit for expenses related to food and beverage catering services. So if you incur any expenses in relation to food, they are not allowed as input credits. But as Abha has mentioned earlier, that if you are incurring those food or accommodation expenses at remote locations or remote on-site, where there's no alternate means to arrange food or accommodation for your staff, in that case, whatever VAT you pay to your supplier, that can be claimed as input credit.
Okay. And look, the last question then, do we have to fill any form when we are in a claim position, or will this be automatically adjusted in the next filing?
So as a taxpayer, you have two options when you are in a refund position. Option one is where you claim a cash refund from the tax authority. If you intend to do that, then you need to submit a taxpayer's checklist, either on a quarterly basis or on an annual basis. But that is a separate submission that needs to be made. The tax authority will look at the responses or the data provided in the checklist, do a desktop audit before it confirms or rejects your refund application. The other alternative is where you are in a refund position, but you don't want to claim the refund in cash from the tax authority. You want to carry it forward as input tax credit in the subsequent quarter, because you assume your liabilities in the next quarter will be higher than your input tax credit. In that case, you do not need to make any separate declaration to the tax authority. That is a part of your VAT return compliance.
Okay. Thanks, Abha. Thanks, Abdul. Thanks, Sumit. Look, thanks everybody for joining us. I appreciate we've gone 10 minutes over time. I think most of you have stayed on for questions. If I have missed any questions, I apologise. The chat's open, so to the extent that I've missed some questions or there's any follow-up questions, please let us know, and we'll get back to you in writing on those. But thanks for your attendance today, and enjoy the rest of your afternoon. Ciao.
Thanks, everyone.
Thank you, everyone. Bye-bye.
Thank you.